thought, especially given the events of 2022, we'd reach out to everybody and do a webinar to go through some pertinent topics that we think are really important to focus on right now. Our regular disclaimer, as you know, we obviously present information that we deem to be reliable. And if you have any specific questions for the team, please reach out to us directly. As everybody knows, the team has grown quite substantially over the years. You've got your 4 senior advisors, Aaron, John, Ryan, and myself. Our head analyst, portfolio manager, and overall financial guru, Elvis Picardo, will be leading the presentation today. We've added 2 amazing young advisors in the past year that we're lucky to have, Kadeem Samji and Vincent Zeng, our associate portfolio manager, Zah, and we could not survive without our 3 key client service administrators, Christina, Neve, and Mari. So people are familiar with the team. This is a nice slide. I like getting to add to it for the team every year. It makes us feel really good that we're still very well respected, not only within our firm, being one of the top teams of the 500 plus teams nationally, but more importantly, outside of our firm and industry-wide. So again, we were named one of the top 50 advisory teams in Canada by Wealth Professional magazine recently, consistently in the Globe and Mail's top wealth advisory teams. So we're very proud of that. Hopefully it just gives you some solace knowing that the people looking after you, your wealth and your family's goals know what we're doing. Just a reminder that everything is custodied and held at a big safe bank. So that's where your assets are held. Our dealer, as you know, is IA Private Wealth. So think of that as our back office. And our team, Luft Financial, is always here to help you. We continue to teach. We've been, probably the most prolific educators in the Lower Mainland for a long time. We do all the retirement courses for the City of Vancouver, Metro Vancouver, Police Department, Fire Department, as well as the regular courses that we teach for our clients. And part of that process, as you know, is our financial planning process we call our Elevate formula. And the key with working with your advisor in this context of that formula is the process that we follow for you every time we have a meeting. So that process is what makes us and hopefully you most successful, which is clarifying what your goals are in the meeting, figuring out where we are at that specific point, analyzing that data that we have, coming up with solutions, implementing those solutions with the team, and then regular review. The last part I just want to touch on briefly, please make sure that you are proactively involved in the review process. We will do our best to reach out and ensure that we're booking reviews for you. But if you have a financial change, a major change in your life, reach out to your advisor, reach out to your advisor's team members to book that review meeting so we can go through this process with you. I recommend generally minimum you'd want to review your overall financial plan on an annual basis. So our agenda today, for the first 45 minutes or so, Elvis is going to give us a review of the overall markets and an outlook and the changes we've made in the portfolios. John's going to go through this confusing time of year. Should I contribute to an RSP or not? What's a RIF? Should I put money in my TFSA? I'm going to talk a bit about what's been going on with interest rates, mortgages, and our thoughts on real estate. Aaron's going to prep you for this upcoming tax season. So more importantly, where to get all the slips, how to sign on to our app, and then we'll do a Q&A. So without further ado, I would like to present our head portfolio manager, Mr. Elvis Picardo.
Thank you, Robert. And thank you all for joining us on this webinar today. Here's a quick look at what I will cover in my presentation. A recap of 2022 and how we managed the portfolios in an extremely challenging year. The outlook for 2023. And finally, an introduction to our perpetual equity model. I also want to mention that much of the material in this presentation will be covered in our forthcoming portfolio report, which should be out sometime next week. So let's begin by looking at this extremely unofficial list of trends from Bloomberg. Now, this does have some bearing on what I'll be discussing later in this presentation. So disclaimer, please don't try this at home, kids. I don't know what that means. Anyway, let's first look at what's in the what's out category. Some of them are fairly obvious, like calling crypto digital gold. Cryptos got slammed last year, as we all know. Negative yielding bonds. Now, that's a very interesting premise. Back in 2020, the amount of global bonds that had a negative yield, which means that if you put $100 in, you would have a negative return on that $100 or $1 million or whatever. The amount of that pool of negative yielding global bonds was 18 trillion in December 2020. And they were quite common in places like Europe and Japan, where rates were being held at rock bottom levels. But you fast forward it to now, it's a very different story. The last of the negative yielding bonds kind of ran out early in last month. So we've gone from 18 trillion in December 2020 to zero in negative yielding bonds this year. Also, what's out? If you look further down the list at the very bottom, quantitative easing or QE, very much the rage during the last, I'd say pretty much the last 10 years, where rates were being held quite low to stimulate the economy. And just when the economy started going, the pandemic hit and central banks were forced to cut and return to their QE playbook once again. The focus now is very much on quantitative tightening and higher interest rates. So look at the what's in category. Now, Helen Mirren makes that list, well-known British actress. I don't know why she's there, frankly. But what's in? Raising the debt ceiling. I believe the debt ceiling comes due in August of 2023. And this is just like a self-inflicted wound on the US economy every other year or so. Also in defense spending, with the world becoming a more dangerous place last year after Russia invaded Ukraine. Deglobalization, which is an after effect of the pandemic and consequent supply chain disruptions. And very interestingly, something called Chat GPT, which is a new artificial intelligence or AI bot that can answer questions, write essays, program computers, does a lot of things except your housework. So anyway, I tried it out yesterday and I asked it to write a haiku, a Japanese 17-syllable poem on spring. Did a pretty decent job. Then being a portfolio manager, I asked ChatGPT, what would the S&P do tomorrow? And it said, I'm sorry, but I'm not able to predict the future performance of the stock market, including the S&P 500 with any certainty. The stock market is influenced by a wide range of factors, etc., etc. In any case, I just bring it up because it's truly a fascinating piece of software, and it really makes you feel that you are chatting with a live person instead of an AI bot. So try it out when you have some time. Now on to the serious stuff. I mentioned in the Outlook report a year ago that 2022 was shaping up to be the year of the storm after the calm. And that was just the beginning, because it really was an extremely turbulent year. If 2021 was the year when everything went up, 2022 was the year when everything went down. It was among the top 10 years in terms of bad performance for the US stock market, coming in at number 7 on the all-time list, as you can see in the panel on the left. The S&P returned negative 18.1%. The NASDAQ composite lost a third of its value, and it was the worst year ever for US bonds, which had a return of minus 13%. Let me highlight that. It was the worst year ever for US bonds. The TSX did relatively better with a return of minus 5.8%. And that was largely because of the contribution from just two sectors, energy, which was up 30%, and consumer staples, companies like Loblaw and so on, which were up 10%. So these two sectors alone offset big declines from groups like healthcare, which was down 62% on the TSX, and technology, which was down 52%. So overall, a pretty horrific year. Because it was the worst year ever for US bonds, and because it was among the worst years for US stocks, a US investor with a balanced 60-40 portfolio, which is 60% stocks and 40% bonds, had the worst ever year since the Great Depression in terms of performance. A 60-40 US portfolio would have returned minus 17% last year. And the only times that the performance of such a portfolio would have been worse would have been in the 1930s, so almost 100 years ago. So I mentioned this just to give you some idea of how bad things were. Fortunately, it wasn't as bad on the TSX and in Canada, but things were really, really scary south of the border. As you can see in the next chart, it was a sea of red with a few islands of green, like the energy and consumer staples sectors on the TSX, like I mentioned. Commodities had a decent year too, because of the Russian invasion, which pushed up commodity prices across the board. So overall, riskier assets got crushed. All the high flyers of 2021, like meme stocks, stuff like AMC and a few others, which were skyrocketing in the first quarter of 2021, they got slammed last year. Something called SPACs, special purpose acquisition companies, they were down big time as well. But possibly the most important speculative asset that everyone's been talking about, cryptocurrencies, they crashed and burned. The crypto market lost 2 trillion from its November 2021 peak. And at last, I think at the end of 2022, the overall size of the market was below 1 trillion. So it lost like 2/3 of its value. Bitcoin alone was down 63%. Now, the problem was that technology stocks, which were in the vanguard of the advance in 2020 and 2021, were hit really hard as well. Amazon and Airbnb lost half their value. Companies like PayPal, Meta, which was formerly Facebook, Netflix, they lost about 2/3 of the market cap. EV makers like Tesla and Rivian fell the most. So tech companies from Amazon to Zoom or from A to Z lost a lot of money. And here's the thing. The FANG group led the market up in 2020 and 21. So these are the world's biggest companies, names like Apple, Amazon, Google, Meta, Microsoft, Tesla, half a dozen of the world's biggest companies. They accounted for half the S&P 500's decline in 2022. They were stellar in leading the market up for the 4 or 5 years before 2022, including during the pandemic. But last year, they contributed a lot to the downside as well. And collectively, these 10 companies in the panel on the right, they lost 5.2 trillion in market cap. Now, just to put it in reference, Canada's GDP is 1.7 trillion. So this wealth destruction is equivalent to 3 times the Canadian economy. So that was a heck of a hit, a really big hit. So what caused the carnage? Like I mentioned, the biggest companies fell, so did the small companies. They all fell alike. There were a number of factors that contributed to this downside. Extremely overbought market conditions, high valuations, extremely high speculative appetite. And all this was brought on by the flood of cheap money during the pandemic. When the pandemic first hit, the markets fell like 35 to 40% in a matter of weeks. But as the money kept sloshing in, as governments around the world became so generous with their stimulus plans, people started buying everything and anything. Initially, the money went into the safer stuff, bonds, stocks, and so on. And over time, over the next few months, it started going to more and more assets on the speculative fringe. So I think it was quite inevitable that the day of reckoning would come at some point. And it happened in 2022 when interest rates went up by pretty much the fastest pace in history for most nations. One contributory factor was Putin's invasion of Ukraine in just over a year ago. Now, this was the second wildcard event. A wildcard event is defined as a low probability, high impact event. It was the second one in 2 years, the first one obviously being the pandemic in Feb and March of 2020. The invasion happened just as inflation was spiking. A year ago, US inflation was at a 40-year high of 7.9%. So when the Russian invasion occurred, it set off a chain reaction of inflationary expectations led by spiking prices for crude oil and commodities. And in response to this surge in inflation, central banks around the world hiked interest rates at a near record pace, as I just mentioned. Why? Because they had a lot of catching up to do. After spending all of 2021 reassuring us that the pickup in inflation was only transitory and it would ease once supply chain pressures eased and people went back to work. Well, that didn't really happen. So how did we manage our portfolios in a very challenging year? We were very active in managing our portfolios. And as a result, just to highlight one model portfolio, which is a flagship pension model. It's the biggest one by far at Luft Financial. It did better than most balanced growth ETFs in 2022. It was down just over 11% last year, but it beat a comparable balanced growth ETF like Vanguard's VBAL by about 200 basis points. That's a pretty significant spread. The good news is that at the present time, more than half of those losses have already been clawed back because the markets have been, pretty strong. The biggest positive contributors to performance were our Canadian and US stock picks. Names like, Pembina Pipeline, Loblaws, which owns superstores, Hydro One, which is a utility out east, Nutrien, which is the global leader in fertilizers, J&J, Berkshire, Barrick Gold, Manulife, household names in Canada and the US. Most of these stocks, they have attractive valuations, they have good dividend yields, very strong balance sheets. So they really fit the bill in terms of what we look for in our stock picks. On the downside, some of our star performers in previous years like Qualcomm and Disney, they encountered a lot of profit taking and they were among the biggest decliners in 2022. On to the next slide. The biggest negative contributor to our model performance, was a Platinum Growth Fund, which returned minus 17.4% in 2022. Now, growth funds of all stripes were hurt by rising yields. And for example, a 17% decline is pretty bad, but it's still about half of what the NASDAQ lost. And at this point in time, the Platinum Fund is recovering very nicely because growth is rebounding quite strongly. We are very confident in the long-term prospects for Platinum, and we have been adding to positions every time we rebalance. As a refresher, I should remind you that Platinum Growth Fund is a group of about 9 or 10 mutual funds that are run by some of the best fund managers in Canada and elsewhere. The key to managing portfolios during times like what we had last year was proactive rebalancing. We rebalanced portfolios throughout the year to capitalize on market volatility. So what happens is at times like, let's say, July and August when the markets went on a big run, pulled back in September, went up again in October, November, came down in December. So the markets rip higher. We tend to take some profits, sell some of the stuff that's done really well, trim some positions, and we use those proceeds to buy stuff that's lagging. And when the markets go down, we buy really aggressively. And that kind of discipline works extremely well when you have the markets doing this, going up and down. So we made a lot of changes to the portfolios last year. In November, we took quite a few steps to improve portfolio quality because we thought that 2023 could be another challenging and not as bad as 2022, but certainly the prospect of a mild recession is, it's quite likely. So how did we improve portfolio quality? We added half a dozen blue chip companies in diverse sectors, and we added a couple of bond ETFs to increase the defensive tilt. By defensive tilt, I mean that when the markets go up, the stocks will lag the advance a little bit. But more importantly, when the market kind of takes a dive, these stocks will hold up extremely well. So the stocks we bought in November include Brookfield Renewable Partners, which is the leader in clean energy, Fortis, a household name in BC and the largest Canadian utility, Medtronic, which is the global leader in medical devices, extremely strong company. And if you look at the demographics, if you look at the demand for its products in the years ahead, I think the sky's the limit. Salesforce, which is the leader in customer relationship management, which coincidentally we use at IA and Luft Financial as well. Salesforce has been expanding into e-commerce and data analytics. It was up 29% for the year as of yesterday. And that was largely because an activist investor has bought a big stake in the company. He wants to shake up the management and unlock value. And usually these guys do a decent job of it. And finally, Unilever, which is a household name in much of Asia and one of the largest consumer staple companies globally. So these companies are as blue chip as they come. Most of them have got very solid dividend yields. And like I mentioned, extremely strong balance sheets. So I have really happy with these picks that we've made. And I think they'll do very well over time. One change that we made subsequent to the year end was last month when we sold Shaw Communications and bought Rogers with the proceeds. Now, in March of, 2021, Rogers announced a takeout bid for Shaw at a cash price of $40.50 per share. And ever since that period, Shaw has been trading in the mid-30s. So there was a pretty significant discount to the takeout price. And we didn't really want to sell Shaw at that price, so we held on to it. But in January, when things started moving and there was much more optimism that the deal would happen, Shaw traded up to close to $40. So we sold it at that point and we bought Rogers with the proceeds. Rogers, as we all know, the biggest the wireless company in Canada, has a dividend yield of over 3%, trades at a discount to rivals like TELUS and BCE. We think the stock will do extremely well over time. Now, the next slide, I covered this in our last webinar in July, but just to refresh your memory, when do we rebalance? We rebalance your portfolios, at certain trigger points, like when you add funds to your account, when you make changes to our model portfolio, and when certain market levels are reached or breached. So, for example, the last time we had a big rebalance was in November of 2022. So we look at if the markets have moved plus or minus 7.5% from the levels where the last time we rebalanced, we will rebalance again. So on average, we rebalance about at least 4 times a year, all models. And for most accounts, I'd say we rebalance at least 6 to 8 times per year. So we are quite active on that side. And as of yesterday, if you look at the chart here, it shows us, we track this on a daily basis. We look at what the current level of the market is and where we should be rebalancing. And as of yesterday, we were about 3 to 4% away from our upside rebalance target levels. So now is the part where I need to use my crystal ball, looking ahead. So, we're done with the bad news. 2022 was a bad year, but we really think the worst could be over. Here are 5 reasons for optimism. January got this year off to a great start, and the momentum has continued so far into Feb, with the TSX, as of yesterday's close, up almost 7% for the year, the S&P 500 up 8.5%, and the Nasdaq up almost 16%. So there's a well-known axiom in the market that says that as goes January, so goes the year. And if that holds up, we could be in for a solid 2023. Point number 2, inflation pressures may have peaked, according to incoming data. Inflation is still high, it's about 5 or 6%, but the trend is definitely downwards. Point number 3, central banks are slowing the pace of rate hikes. The Bank of Canada announced last month that it would pause while it assesses, the impact of past rate hikes. And only last week, the US Federal Reserve raised the Fed funds target rate by 25 basis points. And while the Fed Chairman Powell said that rates may need to keep rising, his recent comments, including yesterday, have been much less hawkish than feared. So what that means is he's still saying that rates will go up, but he's sounding, he's not kind of warning investors to be careful about how high they may go. Point number 4, the global economic picture looks better than it did last year. The risk of recession in Europe has receded quite a bit. And that's largely because a warmer than average winter has kept a lid on energy prices. Going into winter in the fourth quarter of last year, there were real concerns that because Russia had cut off natural gas supplies to Europe, the continent would literally freeze and economic growth would plunge. Fortunately, because the winter wasn't too warm, nat gas stockpiles remained high, and the economy has managed to weather that particular challenge. Another important fact, China, it's emerging from the rolling COVID slowdowns or the lockdowns that had hurt economic growth so badly. If you recall, I think it was sometime in January that China kind of abandoned its zero COVID policy, and it pretty much opened up everything. And we haven't seen too many negative repercussions from that move. So if China starts growing strongly this year, that would be a real boost for the global economy. And point number 5, as a result of all these factors, in North America, there is growing optimism for a soft landing, which means that growth will slow, but there wouldn't be a recession. And if there is a recession, it might be a mild one. So let's look at some of these factors one by one. As I mentioned, last month, the Bank of Canada hit the pause button. It raised its benchmark rate for the 8th time to a 15-year high of 4.5%. But it also said that it expects to hold the policy rate at the current level if economic developments evolve in line with its outlook. And what is the outlook? So the bank expects economic growth to be flat through mid-year, that's this year, but pick up later in 2023. So it expects a 1% rate of economic growth in this year and 2% next year. That's pretty modest growth, but it's growth all the same. And also importantly, it expects CPI inflation to come down to 3% this year and come back to its 2% target in 2024. Now, if that does happen, it would be really encouraging. If you look at the chart on the left, it shows that housing is expected to impede growth by 0.7 percentage points this year. It actually hit economic growth by a full percentage point in 2022. So the impact is expected to be a little bit less this year. And next year, it's expected to actually make a small contribution to GDP growth. If you look at the top line on that in that panel, consumption, which is the spending that we all do, it's also expected to slow significantly from 2.7 percentage points in 2022 to 0.7 this year. So this is the real issue here. If the Canadian consumer, who's currently holding the highest debt in history, if the indebted Canadian consumer slows spending dramatically and housing slides by another 10%, last year it was down by about 13 to 15%. If it slides by another 10%, then Canada could have a real problem. But at the present time, the Bank of Canada seems to be pretty optimistic that that worst case scenario will not come to pass. And as mentioned, on the 1st of February, the Fed raised the benchmark rate by 25 basis points. The markets actually rallied while Chairman Powell was saying his comments, because he said, people obviously investors and traders, they're hanging on to every word that Powell says. He mentioned something about the disinflationary process having started. He said a couple more rate hikes may be coming, but disinflation has started, which means that all these rate hikes that the Fed did last year, they're actually taking a toll on the economy and they're slowing down inflation. And that was enough to send the markets off to the races again. So this is a bit encouraging. We'll have to see where the Fed eventually stops, but it does look encouraging at this point. So who's right? Is it Mr. Powell or Ms. Market? Every trader knows that you don't fight the Fed. It's a well-known saying. So the recent market rally, is either a colossal miscalculation by traders and investors, or the other side of the coin is that the markets are right and inflation will soon abate. And that will force the Fed's hand in terms of halting this relentless pace of rate hikes. Turning next to the global growth outlook, because that's what ultimately drives earnings in the markets. Now, the IMF publishes its annual outlook twice a year, and it has quarterly updates as well. And usually it's pretty gloomy in its economic forecasts. I can't remember the last time when I went through the outlook and I thought things were looking up. But the outlook report in January actually sounded cautiously optimistic for a change. So the IMF expects, so last year, for instance, it kept saying that, we're headed for a recession, the global economy is going to slow down dramatically, and so on and so forth. But in January, it said that it expects global growth to bottom out this year and begin rising in 2024. And the biggest contributors to this turnaround would be the emerging markets, not so much the developed economies as the emerging markets. So let's turn to the earnings outlook. This is something we monitor all the time as fundamental analysts, because the earnings that you expect from an index, it makes a very big has a big impact on the eventual direction of the index over time. So this year, TSX earnings are expected to be flat. And in 2024, they're actually expected to decline a little bit by about 3%. Currently, the TSX trades at about 13 times 2023 earnings per share. For the S&P 500, earnings are forecast to increase about 3% this year and at 11% pace in 2024, which frankly I find a little hard to believe. The index trades at about just over 18 times EPS for 2023. So these valuations are kind of, the middle of the road. They're not exactly cheap, but they are better than they were a year ago. And in terms of valuations, note that the S&P 500 typically trades at a pretty significant premium to the TSX because it has much higher growth exposure, which is largely due to the technology base that it has. Targets. We also look at strategic consensus targets for the TSX and S&P 500. Now, these targets are something that I'd call them the best case scenario because you're perpetually optimistic. At the present point in time, the target for the TSX for the end of this year is just over 23,000. But that's a 8% cut from the peak of over 25,000 last year in April. For the S&P 500, the target is 4,580. The peak was 5,325 in Jan 2022. So that's a 14% cut. So these cuts mean that strategists are getting a little more realistic about what the indexes will achieve over later this year and next year. And in terms of where we are now and where these best case numbers are, it's about 11% to 12% upside from these levels. So they do expect decent upside in the markets. And my take is that if we get even half of that upside, I'd be pretty happy. So what are the risk factors that could affect the markets? There are a few reasons for caution. One thing is that reliable economic indicators like the leading economic indicator, LEI, and the US yield curve, which is the difference between yields on 3-month treasuries and 10-year treasuries, they both point to recession, right? Another risk factor is inflation. What if inflation is actually here to stay? In an ideal world, the Bank of Canada and the Fed would like to see unemployment tick up a little bit so that wage growth is restrained, because labor costs are among the biggest input costs for most businesses. But if the job market remains tight and employees demand higher wages to combat inflation, the end result would be stagflation, which wouldn't be positive for stocks. Another big risk is geopolitical factors, something that we are all aware about after the conflict that erupted last February. What if that Russia-Ukraine conflict widens now that the West is arming Ukraine with more weapons? But there's something unusual on this list, and you probably noticed it. The pandemic doesn't even make this list. That's because I think pretty much most of us are hopeful that we are seeing it in its final stages, and it will not pose the threat to the global economy that it did a couple of years ago. So overall, this is a really good environment for stock picking because good stocks have the potential to outperform broad market indices. And the reason is that those indices cannot post double-digit gains like they did in the last few years because earnings may have topped out. If you look at the chart on the left, earnings have peaked and they look like they're rolling over. So this is a great opportunity to pick up good stocks at fire sale prices in some cases. As well, investors are getting tired of reacting to news on inflation and Fed comments. There's a much bigger reaction nowadays to earnings, which means that people are returning back to fundamentals rather than big moves in a reaction to macro developments where everything goes up and everything goes down. We would be much happier to see stocks reacting to fundamentals like earnings and corporate developments in a positive way. Today, for example, CVS, which is one of the stocks that we hold, did really well during the pandemic because of the rollout of the vaccines and whatnot. That stock's lost a little bit of steam over the last 1 year, but today it bounced up quite a bit because it made its second acquisition in the healthcare space in the matter of a few months. So normally when a company makes an acquisition, investors sometimes look with disfavor on that because they think you're paying too much for it. But in the case of CVS, it was very well received and that's a positive sign. So let's turn now to a perpetual stock model, which was launched on the 30th of June 2022. It consists of 20 to 25 stocks with a little exposure to alternative fixed income. It's extremely well actively managed, and the hold periods for stocks are much shorter than we would have in the bigger models. This model holds stocks that are growth oriented, or what we call special situations. Special situations mean stocks that are temporarily depressed, but which have a catalyst that can unlock value. I think this model is ideal for TFSAs. But the point is that you need to hold it for at least 3 years. If you need that money in a year or two, it's not going to work out, because we would really like to hold these stocks for an extended period of time. The management fee on this model is a little bit lower than what we normally charge, but bear in mind that it does have a performance fee component to it. Potential for higher returns means you can expect this portfolio to be up and down quite a bit, more volatile. And finally, there's minimal overlap with stocks held in our other models. So I'm going to just highlight 3 case studies about the stocks in this model. The first case study is Twitter, which was very much in the news last year. So our entry price for this on June 30th was $37.38. So what's the rationale? There was an offer from Elon Musk on the table for Twitter, but the stock was trading at a 30% discount to Musk's cash buyout offer of $54.20. And why was that? Because there was a great deal of skepticism about the deal getting completed. From the time that Musk made his announcement to the middle of the year, the markets tanked, Twitter went down as well. So Elon Musk was trying to get out of completing the acquisition. So Twitter rightly said that they would take Musk to court to force the buyout. And in October, the case went to trial. So while the case was being heard, on October 4th, I think Musk had a change of heart. He made an abrupt U-turn and he said that he would complete the acquisition. So the very next day, the stock popped and we sold the full position for a 35% profit. Now we sold at about at just over $50. So we left about $4 on the table, but there was a very good reason for doing that. Musk he's a genius. He's also a mercurial guy. Changes his mind from one moment to the next. I didn't want to take the chance that he would back out of the deal once again and get the stock dropping back to the high 30s or $40 or somewhere around there. So we took our money and we were quite happy with the gain of 35% on that position. The next case study is another fascinating one. It's a biotech called Biogen. So Biogen it's got a very broad product portfolio. It's a profitable company, focuses on treating neurological and autoimmune conditions such as multiple sclerosis, Alzheimer's, Parkinson's. In June of last year, it was trading at a 9-year low. And that's because, it had a promising drug candidate for treating Alzheimer's, but there was a lot of skepticism about this drug because its previous drug called herein, also for treating Alzheimer's, it had a failed rollout. It was controversial because there was conflicting evidence about its efficacy and its high cost. So it was supposed to be a big growth driver for Biogen. It was not proving to be the case. The stock, lost ground steadily. It was trading at a 9-year low in June of 2022. I thought it was a great deal at that price. So we took a position in it. On the 17th and the 27th of September, Biogen announced positive results for a new Alzheimer's drug that it was developing in partnership with a Japanese company called Eisai. And the stock surged 37% overnight. So we sold at an average price of close to 280 in 2 separate trades that were 2 months apart. And we realized a gain of 37% on the position. So this one worked out very well. A third case study is another household name, is Boeing. Boeing's had a troubled kind of time of it over the last few years. In 2018 October and 2019 March, there were two horrific plane crashes of its new Boeing 737 MAX jets that claimed a total of 346 lives. So globally, the jet was grounded while safety studies were being done and so on. And then the pandemic hit and global travel, air travel slumped completely. So Boeing fell a lot. It was among one of the biggest decliners on the indices when the pandemic hit. I remember that back in March 2020. And it lost about 70% of its value by June. It was trading, at about $135, $140. So despite news coming out that was fairly positive, like there was chatter that the 737 would be back in business shortly, deliveries would be rising, cash flow would improve. Investors were still quite wary about the stock. So we jumped in because the catalyst was that we thought air travel would recover quite strongly. And as the company made more deliveries of jets, cash flow would improve. So from September 30th, the situation for Boeing improved a lot, and it was up almost 70% by the end of Jan. So we sold half a position at $208 on the 19th of January, just ahead of earnings. We still have a half position in Boeing because we think that the stock can go even higher from here. So those are three case studies that successes we've had in this portfolio. We've also booked gains of over 50% on a gold producer called Alamus Gold. We've taken part profits in diverse companies like PayPal, Xylem, which is a water technology company. So the portfolio presently also holds great stocks like Costco and Lululemon. The only overlap with the stocks that are held in our bigger models are Disney and Salesforce. So I'd strongly suggest that you consider this portfolio for a TFSA or even your other accounts if you have a time horizon of at least 3 years. So I think right on time, that brings me to the end of my presentation. Thank you very much for your attention. Thank you for being a valued client of Luft Financial. I'd be happy to answer any questions at the end, and over now to John Glougie.
Thank you, Elvis, and thank you very much for your presentation. I know it's always a pleasure listening to you speak, and especially when you sprinkle in some optimism. Thanks for doing that. We could all use a little bit of that, right?
Yes.
Thanks, Elvis. So I'll take it from here, and as Elvis mentioned, or maybe Robert mentioned, or both, I will be speaking about the RSP platform today. And even as I mention it right off the top, I imagine there's probably a handful of people here who are getting maybe a little anxious or maybe a little bit nervous. Why would I say that? Because Coast Capital Savings did a study, and they polled Canadians and found that roughly a third of them get anxious or a feeling of guilt when they hear the word RRSP or the phrase RRSP. And I'm thinking to myself, well, how sad is that? The RSPs are actually quite cool. They can do lots of they're a great tax planning tool, great retirement savings tool. So I got to believe that some of this guilt or anxiety or just this general sentiment that RSPs are no longer cool has to come from either not really understanding how to best use them, or maybe knowing how to best use them and not using them themselves, or maybe a combination of both. So I want to spend a few minutes today talking about the RSP, defending its good name, and letting everyone know it's okay to use. They're actually quite neat. So first of all, let's talk about it. What is an RSP and why should we even use it in the first place? Well, an RSP, when you think about that phrase, think about an RSP as a personal pension plan. What is it used for? To provide you with additional retirement income. That's it, as simple as that. It's not that dissimilar from, say, a pension plan, a municipal or a federal pension plan or Canada pension plan, which we all have in common. What an RSP allows you to do, much like a pension plan, is to take some of the dollars that you're earning right now, that you're not going to spend right now, moving those into a tax shelter to say, I will spend them later in life. So you don't tax me on the dollar now, you tax me when I retire and I take the dollar out. That's what the Canada pension plan does. If you've noticed, when you get paid, Or if you're self-employed, you're going to settle up the bill at the end of the year. If you're a salaried employee, when you get paid, that is a line item deduction. You will make contributions to your Canada pension plan. Again, dollars you're not going to pay tax on right now. You're going to put them into a tax shelter, and you're going to get all of this back in income as income in retirement at presumably a lower tax bracket. Now, with the RSP, it's no different. You put $1 in the RSP, you don't have to pay tax on that dollar right now. If you've already paid tax on the dollar, again, as a salaried employee, you take your after-tax dollar and throw it in the RSP, the government will give you the tax back. You can keep all of the money in the RSP all the way until you retire, or until the end of the year in which you turn 71, at which point you have to convert it to what's known as a RIF, or a Registered Retirement Income Fund. But by and large, you basically defer all of this money and keep it growing tax deferred in the RSP until you retire, until you're ready to spend it. That's when you draw the dollar out. That's when you pay the income tax. So some people might be listening to this preamble and say, yeah, I know all this, John. This is still not that exciting. And I think some of the problem is that when people see that point on this slide, number 3, and they say, well, we have to convert this to a RIF, my RSP to a RIF at age 71, and I have to start taking income out the next year. So I'm going to try to do that. I think I'm going to try to keep my money in the RSP as long as humanly possible. That's when I'm going to get the most value out of this. Know this, when the money gets into a RIF and when it comes time to draw the income from the RIF, you are required to take out a minimum percentage based on the value of the RIF every single year. And that minimum percentage will increase the older you get. So if you are one of those individuals who says, I'm going to try to hold on to this forever and ever and never spend this money, just know by the time the government forces your hand, you will likely have a larger RIF and a larger minimum requirement to pull it out. That's where we can run into tax issues. So let's look at this a little closer, specifically the RIF component. When you put money into an RSP, that part feels good. You save in tax, you're getting tax refunds, everybody's loving it. When you pull money out, everyone gets offended that you have to pay the tax at that time. But know this, as long as you, the annuitant of the RSP, are 65, if you take $1 out and you have a spouse, you can split that dollar 50-50 with your spouse. So you can actually reduce your own income and let your spouse claim some of it. Much like your pension income, Canada Pension Plan, any municipal or federal pension plan you may be a part of, all of the income you receive from these sources, if it's pension income, including your RIF, applies to this pension tax credit, both federal and provincial. So in other words, when you're retired and you're earning pension income from pension plans or RIFs, the first $3,000 of that is effectively tax-free. The other thing we want to tell you about a RIF is again, don't necessarily defer it, right? Don't try to leave it in there as long as possible. Think about this. When you retire, when are you going to take your pension income? When are you going to take your Canada Pension Plan income? Think about the RSP in the same light. That's when you should be taking money out of an RSP or a RIF. Nobody should be putting money into an RSP without the intent of spending it in retirement. That is the whole point. Put it in now, the tax, but spend all of it in retirement. That's the point. And spend it slowly and surely throughout the rest of retirement as additional retirement income. It's not a great place for larger lump sum withdrawals because of the tax implications, but it's a great place to start taking income from for the rest of your life. Now you have the option, again, with the RSP, there is some wiggle room. You have some say as to when you turn the income on, to a degree how much you take out from the RSP or the RIF, and the frequency by which you take it. It could be monthly, it could be quarterly, it could be annually. But just know, as soon as you retire, or in other words, as soon as you need the income, don't feel guilty or anxious about spending it. That's what it's there for. Please spend it. And I bring up this slide to kind of maybe reinforce the points I've just made. What we're doing with the RSP, and it's very topical right now, for anybody who may or may not be aware, you have roughly 3 more weeks to make any last-ditch RSP contributions to your RSP and have them applied to your 2022 income. Now, and this is where people say, well, should I? And how much? If I should, how much should I put in? We look at the tax system in Canada to make that determination. And I'm here to tell you that in Canada, not every dollar is taxed the same. So on this slide, humor me and let's just use some numbers I'm pulling out of thin air. If I'm an individual who makes $150,000 a year, that puts me firmly in the 40% marginal tax bracket. Now, that doesn't mean that every dollar I've earned was taxed at 40 cents. It just means that the next dollar I earn is going to be taxed at 40 cents. You go down the list and you look at all those different income brackets on the left side of this slide, and that will show you the incremental portion of your income that gets taxed at that percentage just to the right of it. So what I don't want are Canadians to look at this and say, well, I shouldn't earn that much money then because I'm going to pay so much in tax. It's the wrong way to think about it. Think about if you're earning a good income and you're in a really high tax bracket, think about the RSP platform, because the RSP contributions are one of the only things that allows you to climb back down the income tax bracket ladder, right? So case in point, I'm that individual who makes $150,000 a year. I'm in a 40% tax bracket. If I throw a dollar in an RSP, and let's say I'm a salaried employee, the government says, well, you get to deduct that dollar off your income. And you've already paid tax on the dollar and you shouldn't have. So we're going to give you the 40 cents back as a tax refund. You're thinking, great, this part sounds fun. When I retire, if that individual, say, earns $75,000 in pension income, now they're in a 28% tax bracket. And at that point, they're saying, okay, I have to get the dollar out of my RIF. And the government says, yes, you do. And by the way, you owe us 28 cents in tax. At which point you should be saying, no problem. You gave me 40 cents back way back in the day. And then I invested that dollar and I let it grow. And now I'm taking in the same dollar out and you're only charging me 28 cents. You win by 12%, even if you didn't invest the dollar. So when you're thinking RSP, it's really a way for you to shift tax brackets, right? When you're in a high tax bracket, throw the dollar in, save the tax. If you're a salaried employee, you get the refund. When you retire and you're in a lower tax bracket, take the dollar out. Yes, you have to pay tax, but that's okay. Taxes in Canada go to things like healthcare, which is just doing fantastic these days from what I understand. So it goes to a lot of good, even in retirement. Paying taxes is not the end of the world as long as you're paying less of them. So here's some strategies for the RSP, some things to think about. Number one, just remember, if the dollar is going into the RSP, it's effectively spoken for as retirement income. It's a great way to pull money out as income, not a great place to pull money from in larger lump sums for things like travel or major purchases. When people say, should I contribute to an RSP? Again, as long as we can establish that first point that you are okay saving this dollar for retirement, we can move on to step two and say, how much did you earn before tax last year? If the answer is over $53,000, you're in a 28% tax bracket, and we can make a pretty good case for making an RSP contribution at this point. And if you can, you should try to contribute to your RSPs monthly. I say this because, again, we have 3 weeks to the RSP deadline for 2022, and inevitably there will be the occasional person that shows up in the 11th hour saying, I got to come up with money quickly because I need to get money into my RSP and I just don't know where it's going to come from. It's that last minute panic that you're trying to avoid by contributing monthly. Now, for anybody who says, well, I want to get two things done, John. I want to retire at some point, clearly, but I also have this mortgage debt and, it's getting a little expensive to carry. So I want to pay it off as well. Which one should I choose? We say do both. Have your cake and eat it too. You contribute $1 to the RSP first. That will spit a refund back to you, which you can take and apply to the debt. Also think about this. If you're not in a tax bracket where it makes sense to use the RSP, but let's say you're in a lower tax bracket, but you did have a rental property or some investment that you sold at a large capital gain in any given year. If you take a portion of that capital gain and contribute to your RSP, assuming you have the room to do so, you can also reduce your capital gain and the taxes payable on it. So RSPs can actually help you in a lot of different ways just to save those taxes. Let's think about that mortgage example real quickly and look at it just a little bit more in depth. Again, assuming you are making more than $53,000 and you're in that 28% tax bracket. In other words, assuming you're in a tax bracket where we would recommend you make an RSP contribution in the first place. And assuming that you do want to save for retirement and pay off the house, this is the math and this is the way we look at it. If you put the dollar in the RSP first, your rate of return is 28%. You're saving 28% in tax. And then if you were to put that same dollar against your mortgage, and let's say your mortgage rate was at 6%, you're saving 6% in interest. So would you rather save 28% in tax or 6% in interest? For us, we say start with the 28%. It's higher, and it gives you a tax refund. And then you take the tax refund, and then you pay it against the mortgage, and you're reducing that interest as well. So it's just a matter of steps. Which one do we do first? You can do both at the same time as long as you're doing it in those concurrent steps. So now that you're all big fans of RSPs, I'm sure, how much can we contribute this year? Well, you can put in 18% of your income every year up to a maximum. In 2023, that maximum is $30,780 plus any unused room from years before. So if you do have unused RSP contribution room and you haven't used it, you're not losing it. It carries forward like a snowball, grows and grows and grows. So in future years, you can make larger RSP contributions, or in years where you have those big capital gains to offset, you can use your RSP contribution room in those years as well. If you're curious to know how much exactly you can put in an RSP, that information is available on your notice of assessment, which is that form you get back after filing your income taxes. Or even more simply put, you can log on to your MyCRA account, which I'm sure is the most popular website out there, and that will have your RSP deduction limit along with your tax-free savings account or contribution limit as well. So why do you use an RSP? Just think about this. Don't be anxious. Don't feel guilty. You're doing it because you're saving on taxes and you're saving for retirement. And I bet you if you put too much in your RSP, or if you've contributed your whole life and you're feeling bad about it, if you get to retirement, you're probably not looking like this guy. Oh, shoot, I saved too much for retirement. I got too much money. I can take too many trips. This is the worst. Don't worry about it. RSPs, this is what they're designed for. Put the money away now, save the taxes with the intent of spending it all in retirement and having fun. Now, if you're looking at this stuff and saying, okay, John, that's all great too, but I'm not in that 53,000 plus category, or I'm retired now and I don't have the earned income and RSPs don't really make sense anymore. Should I just not save anymore? Well, no, you can definitely still save. You can use something like a tax-free savings account. Though we think it's kind of a stupid name, and we'll run through that real quick as to why that is. Kind of a stupid name like SARS Soda here, or at the top there's Outhouse Springs Water. That sounds delicious. Or at the bottom, my favorite is that homemade or black raspberry jam that tastes just like grandma. Yikes. Okay, so why do we think it's a stupid name? Because it sounds like a savings account. And if you just put cash in a TFSA and just sit on cash, are you making any money? Therefore, are you saving any income tax you would otherwise pay on that money? And the answer is probably no. So let's talk about what the TFSA is first, and then we'll show you how to properly use it. If you've never put a dollar into a TFSA and you were an adult back in 2009 when these were launched, you have $88,000 worth of available contribution room to you. If you have been using it along the way, it's likely 88,000 minus whatever you've put in thus far. Now, if you haven't, up until the end of 2022, if you had your TFSAs maxed out, you can put in your new maximum contribution limit of 2023, which is $6,500. And again, you can carry forward any other room that you may have not used in years previous. Now, unlike an RSP, when you throw a dollar into a tax-free savings account, there is no tax deduction, there is no tax savings, and there is no tax refund. But like an RSP, as long as the money sits in a TFSA, it grows tax-free. And unlike an RSP, when you take the dollar out of the tax-free savings account, it never gets added back to your income, and you never pay income tax on it. So it is a really nice account. This would be a great account in retirement for larger lump sum withdrawals, major purchases, travel plans, that kind of stuff, because it's never going to increase your income to the point where you have to worry about getting your OAS clawed back, or you're paying too much in income tax or anything like that. Great account for that kind of stuff in retirement. And just so you know, your tax-free savings account, if used appropriately, would have investments in it, much like your RSP. In fact, let's look at that. If you put $88,000 in and you invest and earn even just simply 4% a year on this money, that means you're making $3,500 a year. The tax on that, were it outside of a tax-free savings account, assuming you were in about a 30% tax bracket, would be about $1,000. The government would say you owe us $1,000 and you get to keep $2,500. But if you do this in a tax-free savings account, you get to keep the whole $3,500. It's all yours. I will also mention tax-free savings account contribution limits. The contribution room you have in a tax-free savings account is almost like a balloon. So in this example, if somebody puts in $88,000 and invests it, let's say the $88,000 grows to $100,000, and they wanted to buy a boat for their good friend John. They take that money out in any given year, $100,000, not taxable, not added to income, nothing like that. They spend it on the boat. They give the boat to me. I'm happy. They're happy. A year later, they say, you know what? Actually, I found another $100,000 under the mattress. I would like to put that back into my tax-free savings account if I could. And the answer is yes, you can. So whatever you withdraw from a tax-free savings account, you can put back into a tax-free savings account as long as you wait a calendar year. So again, you put in 88,000, it grows to 100,000. You take the 100,000 out. Next calendar year, you can put 100,000 back in, plus next year's contribution limit. So they are pretty cool in this respect. But again, they don't really help you come tax season. And that's why we don't really put a deadline on the TFSA contributions. Those can be made at any time during the calendar year. So some of the most common mistakes with the tax-free savings account, quite simply put, cash is king. I hold cash in there. I'm just saving cash in my tax-free savings account. Not the best use of your tax-free savings account. The perpetual growth model that Elvis mentioned right before I jumped on, that is a great place to hold. The tax-free savings account is a great place to hold a portfolio like that, a growth portfolio. The other major issue is just the beneficiary designation. If you have a spouse, just make sure that you've designated your spouse as a successor holder, not a beneficiary. If they're a beneficiary and you pass away, let's assume you each had $100,000 in your tax-free savings accounts. If your spouse is named as a beneficiary and you pass away, the spouse will get $100,000 tax-free and they will still have $100,000 in their TFSA. It's not the end of the world. But as a successor holder, what will happen is the deceased spouse, they're gone, and their $100,000 tax-free savings account rolls into the surviving spouse's tax-free savings account, giving them $200,000 in their TFSA. Back to my point a few moments ago saying, if that spouse wants to take the $100,000 out, they're welcome to do so, but they've created an extra $100,000 worth of contribution room that they can use at any point moving forward. So those are two of the common mistakes we see with TFSAs. Just wanted to run through that very quickly. That's kind of all the time I have today. So hopefully you enjoyed this quick journey through the RSP and TFSA landscape. Just remember, you have about roughly 3 weeks until March 1st to make any RSP contributions that you would like to apply towards your 2022 income tax. Oh, there is one more slide. There you go. So which one should I use? And I think I touched on this already. Thanks, Robert, for pushing me forward. Use the RSP generally, again, if you want to save for retirement and if you're in a tax bracket that makes sense, earning over $53,000. If you're under that, we're not saying don't save for retirement or don't save for anything. We're just saying save in the TFSA. And that's all I think, unless there's another slide after that. I think I'm done now, Robert. I think you're welcome to come back.
Good. All right. Thanks, John. That was very informative. So I've been tasked with, I guess a little bit harder of the crystal ball kind of discussion. Elvis has his magic lamp. My crystal ball is under the table. It doesn't work very well, as many of you know, but we're going to give this a shot anyway. So I want to have a quick discussion on topics that come up at every financial planning Elevate review that I do with clients generally. And it's a topic of conversation that obviously happens quite a bit at every household in BC and now across Canada. So what's going to happen with real estate? Where do we see mortgage rates going? And a little bit more discussion to add to the discussion that Elvis had regarding interest rates. So we all know the basics here. Interest rates have increased massively in the short term. To many people that might be new to investing, and I'm talking, in the last 10 years or so, this concept of rising interest rates was maybe just a fairy tale told by old slugs like myself. Same being for things like mortgage rates. Mortgage rates are perpetually low. Interest rates are perpetually low. So that means, Robert, that real estate only goes up, correct? So what have we seen here? Well, central banks around the world continue to deal with this bugbear of stubbornly high inflation caused by numerous factors, not the least of which was their own doing by keeping interest rates historically low, potentially for too long. So what is the mechanism that we can utilize to combat inflation? And that is raise rates. So in the past, many pundits might tell you, especially some of the places you might be getting some of your economic information from that, we can't raise rates. It would cause massive carnage amongst the consumer, not the least of which amongst corporations. And, what about the balance sheets of the average Canadian? So let's talk about that. So Bank of Canada Prime now sits at 6.7%. So the Bank of Canada handed borrowers a really not so surprising rate hike of 50 basis points, which is just a fancy way of saying 0.5% to end the year. Merry Christmas. And another 0.25% raise on January 25th. So in 2022, that prime rate that you'd have on, say, the best rate that the bank will give you on a line of credit generally secured went from 2.45 the start of the year to 6.45. And now sits at 6.7%. So what happens when you raise interest rates? You're trying to reduce people's expenditures. Now, what happens if I wasn't, conscious of my spending and wasn't conscious that rates could go up and I borrowed out the wazoo? What does that make me? Generally, it makes you Canadian. So what's going to happen? If we have further rate hikes, which, the Bank of Canada's Tiff Macklem is very much signaling he does not want to do, what he has signaled to the markets as early as discussions yesterday and the last couple of days is that we are going to take a pause. And why do I take a pause? Because I've already massively increased your cost of borrowing in the past 12 months, and I'm going to take a little bit of a wait and see approach. Okay, so these rate hikes we've seen, I do not believe we have seen the full effect of what these hikes are going to do to the average Canadian. I definitely agree that you're going to see a continuing cooling of housing prices and potentially a dampening of demand across the country. Now, we have seen slowing inflation. The December CPI release showed 6.3% inflation in December, which dropped from 8.1% in June. Okay, so maybe now the Bank of Canada is allowed to take a bit more of a relaxed pace to its rate hikes, or maybe not hike rates at all. But the damage, I think, has been done. So, we've got these fears of a recession, and quite often I've found historically, if somebody tells you we might have a recession going forward, it probably means you're already in one. And I'm gauging what's happening with people's balance sheets. We've all heard in the media, recently that the average Canadian could maybe be one or two paychecks away from, insolvency. When I drive into work every day, one of the most common radio ads that I hear is for bankruptcy trustees and consumer proposals. This is not a good sign. So when's the next interest rate announcement? That's going to be March 8th. We definitely would assume that rates will not go up. The other thing that the Bank of Canada is doing, according to notes from the IMF, is they're going to start to release the minutes of their policy meetings. So they're going to tell you in a little bit more detail what they were talking about kind of behind the scenes. So how does this really affect us? Let's talk about how this affects the average person, the real estate they hold, the interest rates they pay, and the mortgage rates they face. So look at it this way. Prime at January 24th, top of the slide there is 6.7%. Okay. So if you borrowed money, going back 12, 13 years ago, prime was as low as 2.5%. So when you've seen the cost of borrowing rapidly increase as fast as it has think of March of 2022, you went and got your secured line of credit, you went to the bank, it was at 2.7%, you secured that to your house, and you went out and you consumed. Let's not kid ourselves here. The average consumer has utilized their house as an ATM machine, securing higher and higher loan to value ratios based on the expectation that the interest rate will remain low and the house value will simply increase over time. And our team has professed caution about this as far back as I can remember, sounding very much like Chicken Little. don't be careful. Rates will go up. Oh, rates don't go up. I've had discussions with mortgage brokers in the past 5 years arguing why clients should be in a fixed, not a variable rate. So this is now coming home to roost. Okay. The rates have gone up. Now you'll start to see going forward the damage that this does to the average consumer. So think about this. You go to borrow money, you have to pass a stress test. Okay. This may not be relevant if you have no mortgage right now. You're thinking, I don't want to talk about mortgage rates. But if you have adult children that are thinking of going out and getting a mortgage, or maybe your mortgage is coming up for renewal, I think this is really relevant information to spend some time on. So you go out and you get a mortgage stress test right now. It's at 8.45%. So it's your mortgage rate that you can get from your lender plus 2 or 5.25. So if you're getting a 5-year fixed at 6.45, you have to pass this stress test at 8.45. Guess what? I've always explained to people, if you can't pay that mortgage at 2% higher rates, you should not take the mortgage that the bank's offering you. My old go-to there is, it's like the hangman. They'll give you enough rope to do the job. So on a 5-year fixed at 5.49, that means you're qualifying at 7.49%. 1 year ago, you could qualify at 4.49%. Okay, so that's 3% higher you have to qualify for. So if you think of borrowing $100,000 at 2%, you pay $423 a month. If you borrow $100,000 at 5.5%, you're paying $600 a month. So a 3.5% increase in the 5-year fixed rate increases payments by almost $200 a month for every $100K you borrowed. So you had a $500,000 mortgage. Now your payments used to be $935 a month. Now they're jumping up to $1,335 of before tax income. So say you make $75,000 a year. That means an extra $16,000 of your income, 20% of your pay, now has to go to cover the mortgage. So now with the variable, the increase in rates of 4% in just over a year, those payments are going to go up 40% on renewal. So guess what the bank does to you? It says, oh, you had a 25-year amortization. You can't make these payments. It's been 5 years you've been making payments. Instead of your 25-year amortization becoming 20 years, it now stays at 25. So they keep you like the hamster on the wheel. The other thing I think it really does, as Elvis showed the slide, is it will really damper consumer demand, okay, for goods and services. Because in Canada, we have recourse mortgages. You can't just walk away. So Canadians tend to do everything they can not to default. So I think where you'll see that massive change is in consumption by the Canadian consumer. So what are some of the solutions we have to this problem? So if you were going to purchase, we always tell people to get pre-approved as far ahead as you can. And there's, banks will usually do 90 to 120 day rate holds for you. Now, we don't necessarily see this as being as imperative now, except for getting your ducks in a row, because we don't necessarily see, the longer term rates trending upwards, or even the short end of the yield curve, so the variable rates. But you get that as early as possible so you're ready to go, right? And using a mortgage broker to help you, basically let them do the shopping. They get paid by the lender. It doesn't cost you anything. The other key would be to make sure mortgage payments aren't more than 30 to 40% of net, not gross. The lender technically will quite often use your gross debt service ratio, which I think is a quite useless number. I want to know how much this mortgage is going to cost me based on how much I take home. So if you're counseling your kids, can they pay that 7% stress test, and will it not eat up more than 30% of their take home pay? Always build in a 2% interest rate increase in the future to your payments now, as if the increase is already there. So when rates go up, if they were to go up, you can still make the payments. Right now, we're really looking to consider maybe a 3-year fixed. So prime, we don't see the prime rate coming down anytime soon. We are still battling inflation. Tiff Macklem Government Bank of Canada has basically said and given us that leading indicator that the Bank of Canada is potentially going to pause raising rates. So, when we're looking out there in the market, hopefully you can read this slide, but if you look at something like Bank of Montreal on a 3-year fixed, I can get 5.19%. Not a bad rate to lock into. You may even now consider a variable, after the rates have already risen. I'd be comparing what I could get on a variable. If I could get that variable at 4.7 versus the 3-year fixed at 5.19, I'm not as concerned now that the Bank of Canada is going to be raising rates any further. So there is that differential of, almost 0.5%. So it's funny because at the bottom, people were going variable. Generally, it's at what we consider to be the top of the interest rate cycle is when you want a variable product. At the bottom, you don't split hairs. At the bottom of the rate cycle is when you go fixed. So I was telling people to go fixed previously. Now, I might even consider a variable product if I had to. This is the interesting one to kind of consider is what happens with real estate from here. So, I didn't have time to update some of the slides from the reading I've been doing in the last few days, but one of the stats that I pulled down that was in the Globe and Mail yesterday or the day before, which I think a lot of people have to really consider. In the downtown Greater Toronto area, where the stats are coming out by CHSP, New Canadian Housing Statistics, hard to say, sorry, up to 40% of all of the condos in the Greater Toronto area are owned by investors. Investors being classified as somebody who already has a principal residence. That's insane. So think about that. These people got interest rates on their mortgages, variable probably at 2%. And guess what you can't do? If your mortgage rate suddenly goes to 6 and the payment goes up 50%, you can't turn around and go back to your tenant and jack the rent up. Now, you can play silly buggers and say that you're going to try to own or occupy it or any of these things. But I think what we're going to start to see in that spring market is an increase in the supply of some of those secondary properties by speculators who now realize the math no longer makes sense. I've had reviews in the last little while with clients seeing that the cash flow now from these secondary properties is not only zero net, so in other words, the rent does not offset the mortgage, the property taxes, the strata fees, and any allowance for maintenance. But that cash flow is not only zero, in some cases it's negative. Now in the past, people would suck it up and hold on to that negative cash flow. Why? Because real estate was just going up. But what we're starting to see is a normalization in the pricing of secondary properties, especially condominiums, whereby we're starting to see the drop year over year, and it'll be very interesting to see if we see a surge in listings. Okay. The other stat that I found interesting was in smaller metropolitan areas, like just outside of the GTA, but within distance of GTA, up to 80% of condominiums and non-detached homes were owned by investors. So it remains to be seen how this is going to play out. But I think two things. I think you're going to see a measurable correction in our housing market. I also see things like consumables in Canada definitely moderating as consumption is massively impacted by an over-leveraged consumer. So by that I mean, as the supply chain issues reduce and China continues to open up, you're going to start to see better deals on some of these big ticket items. So for example, if I was going to buy a car, I'd try to wait till Q3. Okay, so as the car manufacturers ramped up production and the chip shortage waned, these vehicles are going to be coming onto the dealerships at right around the time where the consumer doesn't have any money to buy them. So some of your bigger ticket things like renovations. If I'm already tapped out, if I was thinking of doing a major reno, I might start to wait potentially this summer to see if some of the contractors have more capacity in which case some of the prices might come down. So, it's definitely going to be, the way I liken it is like a car analogy. One of the portfolio managers I respect a lot would always use this. We've been driving on a straightaway with the pedal to the metal for quite a while, and knowing that there was going to be a turn coming up, and all of a sudden what they've done is they slammed on the brakes. So instead of slowly weaning us off this cheap money, what the Bank of Canada has done is they've slammed on the brakes, and they know there's going to be an accident. And I think that accident happens with over-levered consumers that have a lot of debt in the secondary housing market. So with that happy conclusion, I'll pass it on to Aaron to discuss tax and tax slips.
Thanks, Robert. Well, growing up and living in Vancouver, I know how much people love to talk about real estate, and I get the pleasure of following that up with everyone's favorite second topic, taxes and tax time. Much like where John talked to you about the anxiety and kind of stress around RSP season, I'm sure tax time is even higher, trying to ensure you have all your slips and did you file correctly and all the information, when is it coming and all that. So hopefully today I can just provide a little bit of information, what to expect, and some tips and recommendations on how to do it. Because as we know, like I was saying, our favorite time is tax time, where the government likes to remind us that we owe them money. And as nice Canadians, we want to pay our taxes. We like where we live. We know it costs money, and so we agree, and we say, oh, okay, well, how much do I owe? But the government likes to play a little game here where they want us to figure it out. Even though we're not accountants and this isn't our expertise, they want us to do the work to figure it out. So can we just decide how much we want to pay? No, absolutely not. They know how much we owe, but they want us to figure it out. And if we get it wrong, we go to jail. Well, of course, I joke a little bit on that. But, can we get fined or this or that? Or even worse, if we get it wrong, on the other end, what if we pay too much and we missed something and we overpaid? Ooh, I wouldn't like that to happen, overpaying my taxes, that's for sure. So what to expect this tax season? What tax slips should I expect? Where do I find them? How will I receive them? And then some quick filing recommendations. So here we go. Let's get right into it. What tax slips can I expect? RSP RIFs. So from your registered accounts, contribution slips. So when you put money into an RSP, you're going to get a contribution receipt that's going to allow you to use that to deduct against your income. So the latest mailing date for these, since the last contribution date is March 1st, would be March 15th. So you're putting money in all year. You've already started to receive slips. You're receiving slips up to December, and then every 2 weeks, they're mailing out slips for contributions through January and February. So if you're making a contribution at the very end of the deadline, your slips are going to come out later in March. And that's when they're mailed. Let's remember, this is when slips are sent out, not when you receive them. That's left up to the discretion of Canada Post, another great reliable institution that makes our lives easier. On the other side is when you're taking money out of your registered accounts, like a RIF, or if you take money out of your RSP, you're going to get a T-slip for income withdrawals. Similar to the way that you work, you get your T4. When you take money out, it's income, and that's going to be added to your income and taxable as well. So you're going to get a slip for that. So those will also be sent out. Now, that's not a contribution. That is a withdrawal that was done in 2022 last year. So the latest those will be sent out is March 1st. So you should get those a little earlier. TFSAs. We commonly get questions, I made a contribution to my TFSA, I didn't get a slip. Or I made a withdrawal, should I be getting a slip? Tax-free savings account. The whole point of them being tax-free is that you do not pay tax on any withdrawals, and therefore you do not get any contribution withdrawal receipts or slips, the same way that you don't get any contribution deposit receipts, because there's no deduction to be made against your income. You don't get a deduction for putting money in, and you don't get taxed for pulling it out. So you don't get any slips for putting money in or taking it out. So you don't need to worry about that. The only thing you do need to track is ensuring how much you put in, you didn't go over, and things like that. They'll let you know if you go over. We can track that as well. And on your MyCRA website, there's a detailed breakdown of your contributions, when you made them, withdrawals, when you made them, what institution, and all that. So it's useful information there as well. Non-registered accounts. Now, this is when things get a little more complicated for your tax returns. Is when when you have non-registered investments. So investments outside of your TFSA and your RSP. So this is when I would ask, if people are doing their own taxes or having a professional or accountant do your taxes for you. If you're doing them yourselves and you have non-registered investments, it can get a little more complicated. So your non-registered investments, you're going to get some T5 slips for income, T5008s or T3s income. Now, most of these slips, the latest mailing date is March 1st. However, as you notice there for T3 for trust income, for mutual funds, it can be mailed as late as March 31st. So that's the end of March. Now, again, that's not when you receive them. That's when they are mailed. And we're still waiting on Canada Post. So that's why we highlight at the very bottom there in my slide, do not file your return too early. I know that people are eager and want to get on top of this and get it behind them so they can move on and start to enjoy their spring, looking forward to summer, whatever it might be, but do not file too early. We recommend waiting till at least April 15th or later to actually file. Now, I'm not saying that you can't prepare everything and start getting organized today, and you can even start sending your accountant all the information, knowing that when more stuff comes in, letting them know, well, you can prepare everything, but I might add something. Do not file it until the end of April so that we ensure we have everything. You can notice that most of those other slips, your gain loss report, foreign property report, annual fee letter, investment income summary, and trading summary are all going to be mailed out March 1st as well. So you should have those by the middle of March. So the big one is just that T3s for mutual funds won't be, it could be sent out earlier. You could get it earlier, but the latest file and mailing date they can do is March 31st. These do not come from us. We are not sending these to you. This is out of our hands. It's coming directly from the investment company. On the flip side, the realized gain report, the foreign property report, and annual fee letter, those are coming from us. And I'm getting into some more details on those, kind of where to find them and whatnot, as well as a trading summary, investment income summary. This is just an example in case you've never received like a T5 or T3. These are what the slips look like. They're going to have all the different boxes for you if you are filing your returns and your first time filing a non-registered account. Just wanted to throw that out there for you. So importantly, we know there's going to be slips coming in. Now, where do I find them? How do I get them? Kind of when we're expecting them. So number one, our client online portal and our mobile app. That will have everything that we send you will be available there. You can log in, you can see all your statements, transactions, all that stuff, as well as all your tax documents. My CRA account, I definitely would recommend setting this up. They're going to have all your slips as well there. I'm going to go through these a little bit more. And finally, mail. They get mailed out, check your mailbox. Hopefully everything shows up, but not always dependable. That's why we really want to focus on the first two, the online portal and the CRA, my CRA account. So first of all, our online portal, if you go to the IA Private Wealth website, you can sign in there. I've highlighted on the top corner. Hopefully most of you are set up on this. You can just sign in with your password. If you haven't, you can see there on the right, get started, register, click register. That will walk you through everything you need. If you do need some help or you come across some issues, let us know. We can help you with that as well. But it is pretty straightforward. It is pretty easy. And I believe most people here should probably already be set up on that. So once you're in this is kind of a picture of what it looks like inside the portal to get your tax documents. So you go to the document center, which I've highlighted on the left. Then you can start to filter what you're actually looking for. So you're looking for your tax slips, your year-end report. And you want to look at, just highlight all your accounts, even though for the most part, or this is your non-registered investments for the most part, other than you would be your RSP contribution receipt or your RIF withdrawal receipt. So I would just say highlight all accounts. Just cover all your tax slips that you can expect. So once you can do that, you can see them all, download them, to a PDF, print them, whatever you want to do with them. They're all available there for you to access, email them to your accountant, whatever you need to do. Similarly, the mobile app looks very similar to the web portal, online portal, but it's just obviously made a lot easier to use and see on your phone rather than trying to use a web-based website and program on your phone, on your smaller little iPhone or Samsung, whatever you might have. As you can see on the right, documents, it's the same process. You can, what type of document you're looking for, your tax slips, pull them down. You can download them to your phone. If you want to email them and do it that way as well, it's all there. The app is obviously easy to use. You can log in with your same credentials. If you do have any issues with that, again, let us know. We can help you, but it's all, walks you through it. Is pretty straightforward there as well. So my CRA account, now not always so easy. Is the my CRA account where people are getting locked out. There's issues. I can't see, all the stuff. They're going to mail me my password. It takes a long time, all that stuff. But hopefully most people are already set up and have access to it, because although CRA is extremely difficult to get in touch with on the phone and deal with, the website provides a lot of that useful information to save you hours and hours of time on the phone if you ever have to contact them to get anything. So this is a huge plus and a huge time saver, as well as I'll show you how you can really use it for your taxes, and your accountant can use it to make sure you have everything. So I extremely would recommend having this. As I mentioned, it will also show you your TFSA history, contributions, withdrawals, show you your RSP room, all that useful information, your previous notice of assessments, it's all there. So I would definitely recommend having this. Once you're in your My CRA account, it's similar to the portal. You want to go to your tax information slips. So you can click the link. It'll take you to your slips. Then you can select your tax year. So you select 2022, information slips, all slips. Just take everything, download them, and then send them to your accountant, or print them, whatever you want to do. So how will you receive your tax documents? Mutual fund T-slips, kind of a review. We do not send these or have a copy of these. These come from the third party, directly from the investment firm, the company that it will send to you. Now, one thing I will mention, and this is a plus, that when we launched our Platinum Growth Fund and our Steadfast Fixed Income Fund, we consolidated a lot of our holdings. And we did this for tax purposes, so that you would have a lot less tax slips this year than you've had in the past. So instead of getting 5 or 6 or 7 different slips, you'll get one. So that will make everything a lot easier. And one of the big reasons why we did it. Sorry, one for the Platinum Growth, for all those growth type of investments, and then one on the fixed income side from those two. So instead of having maybe 10 combined, they're down to 2. So it's a lot easier, a lot less filing. And depending on how your accountant bills you, they may bill you per slip. That'll save you some money there as well. Okay, so back to how do I receive them? Mail. They will be mailed to you, the third-party mutual fund T3 slips. Like I say, we don't have copies of these, but they're also available on the My CRA account, and we'll go through that a little bit more. So all documents will be mailed to you from us that we have access to, unless, and this is what's highlighted here, you have previously selected to receive all your tax documents digitally. So if you've checked that box, you've gone on, you're saying, I don't want to be mailed anything. I don't want paper I don't want paper. I want it all digitally. Then you're not going to get the statements in the mail. You're not going to get all the tax slips in the mail. They're going to be available on the client portal and as well on your mobile app. So as a hint, if you haven't received any tax slips and you are expecting some, please check your portal, as they're most likely there, and you've most likely selected to not receive paper copies, but digital instead. So that is where I would go to for the first place to get all of my slips, regardless, that we would have access to. My CRA account, again, they have all your slips, not just from us, but from the third party, from the mutual fund companies. Potentially, if you have a Tangerine savings account, high interest savings account, you're going to get a T-slip from them as well. Well, we don't have access to that, but my CRA will have a copy of that. Tangerine will send you one. They will have a copy of it online as well. So go there where you can get all your reports. However, caveat is that they do not, on my CRA, they do not have the gain loss report that we generate. our fee report or a foreign property report, which are sent from us. Now, these aren't official tax T-slips, right? Like a fee report is what you can use for a tax to deduct the fees on your return. A gain loss report is to provide more information when you report, well, how much did you make or lose on a certain investment and the details behind that to back that up. Those are sent from us. So CRA does not have a copy of that. So I know I've thrown a lot of stuff, information. It's kind of all over. You're going, okay, well, what do I do? What do I do? So rather than even kind of summarize it, I've got just some recommendations on how you should file your return. The process I use personally, you should follow to keep it all very, very simple. Step one, have your accountant or tax program import all of your tax slips from CRA, from the My CRA website directly online. All the copies that CRA has. Because again, remember I joked, they know how much you owe. They have access to this information. So import them all from there, because the mailing slips from the third party or from us, from Canada Post, you're waiting, you don't know what's coming, maybe you missed one. Forget all that. Have them come from My CRA. Now, what CRA does not have copies of, you'll want to provide to your accountant, is the gain loss report, the investment fee reports, you can deduct the management fees, and your foreign property report. You will receive copies from us. These reports are available on your client portal or the mobile app. So you download all your T-slips from My CRA into your program, or you have your accountant download them, you give them access, and they download them for you. You supplement that with these 3 reports that you provide so they can, further, deduct fees and whatnot, have your gain loss report to complete your taxes. It's that simple. But the final step, 2 things we want to do is do not file your return too early, ensure your fees are deducted, and last but not least, review and cross-reference your tax return. So at the end, when everything's done and you filed or the accountant sends it to you to sign off on, look through it and review it. Does it make sense? If you have a big surprise of the amount of money you're owing, you may want to look at it and go, why does that make sense? As I said, I do not want anybody to be overpaying their taxes. That's just as bad as being late or getting fined or, making a mistake on the other end. Either way, it's costing you money. So you want to make sure you review it. When you go out for dinner, I ask, and the bill comes, and if you're anything like me and you take your family out, I look at every little line item to make sure they didn't sneak anything on there that I didn't order. There wasn't an extra drink or an appetizer I didn't want, or I wasn't, the price of the entree is the same on the bill that it was in the menu. If I'm going to review that, $100 bill or whatever it is, and I was going to spend all that time doing that as we do, we should also be reviewing our tax returns annually to ensure that they kind of match with what we're expecting. And if they don't, kind of looking at why. I've come across where people made comments to me saying, oh yeah, I owed like an extra 10 grand or whatever it might be on my tax return last year. I was surprised. I'm going, what? I don't know why. Like, where did that come from? What do you mean? They're like, well, I don't know. I said, well, send me your return. Let me look at it. And then sure enough, when I dig into it, they missed something on it. They had a gain, but they didn't offset a loss, or they didn't have an adjusted cost based on it. And it ended up charging them a bunch of money. They had to refile and go in. Accountants, they're great. They do a job we need them to do. But sometimes during the year, they're not so proactive in looking into it. They're just mainly data entering and filing and getting it done. They're not doing the extra step to dig into it. So that's why it's so important that we review our returns. And that's that for our webinar today. We'll bring everybody back on, and we'll take any questions. If there's any questions on the chat, we can answer them. Was there anything specific that we needed to address? No?
I'm just looking at the Q&A myself. People could either put the question on the chat or on the Q&A. One of the questions we got, I think during your session was, can you give your accountant access to your CRA account as a rep? Yes, so when you log into if you look in the chat there, I put the link to the My CRA account. And there is actually, once you sign in, you can authorize a representative. I usually tell people that's a really smart thing to do because, as Aaron said, then the accountant can go in. That's how they actually go in, and they can double check what you send them. I know for a fact that a lot of the times the accountants would rather have that than rely on you to actually give them all the slips, because the slips will get posted there.
Absolutely. And if they don't, they probably, I don't know how they're doing. They've probably been doing taxes for like 50 years or something, that they don't want to import everything, or they're not doing it that way. But
yeah, and I think some of the things to clarify for people too, like the T3s, the trust income slips, that is where you're getting the slips, as Aaron said, directly from the fund company. Okay, the T5s, you will get T5s from IA Private Wealth, but you won't get a T3 and a T5 if you only have an RSP or a TFSA for us. We can't reiterate that enough, that's only if you have a non-registered, or what is actually called a cash account. So money outside your RSP and your TFSA. Aaron, Madeline Vanessa would like you to redisplay your last slide.
Sure. I think it was just kind of the process there. There you go.
Mm-hmm.
Our faces may be in the way of the bottom point, but
that part just says don't file your return too early.
A couple of things I want to clarify with this too is this one we get all the time. Your investment fee report was with your December statement for your non-registered account. So it's already been sent to you. Okay, so you would pull that up when you get your non-registered account statement. They were pretty late this year. I think I didn't get mine till like mid-January, but that gave a summary of all of your fees. They were late because they have to calculate those fees.
Additionally, there will be a fee report that's not part of that statement that they post as well in the portal.
Say again, Aaron?
There will be a fee report on the portal as well that's separate from the statement as well.
Yeah, you get it. Yeah, it's in both. But I know on mine, I'm still getting them for some reason. I get both. I get them mailed to me and they're online. So I already got my fee report mailed to me. And then I signed into the website, and it is there on your IA Private Wealth portal. Diana says our accountant is not willing to take our info directly from CRA without us emailing it all to them. I would say that's probably just a good accountant, Diana. They're just saying, hey, we just want to make sure you send it all, and then we can double check it. That's
cross-reference.
Nothing wrong with that.
Yeah.
There's a question also from Karen Hasselfeld just regarding my pension tax credit comment. Just to clarify that, what the pension tax credit is applied after the fact, but when you are earning things like pension income, whether that comes from a municipal or a federal pension or the Canada Pension Plan or RIF withdrawals, this income is income that you are allowed to apply that tax credit to. So all sources of it. If you only have RIF income and nothing else, then you can apply the tax credit to the RIF income.
We had a question from somebody saying, okay, it's private, so I won't name you, but when should you collect CPP? So that the base answer that we always give there is once you've stopped working and you're going to spend the money, right? One of the other things to clarify, if you've got two spouses and they're both getting max CPP and one passes, you will basically lose that other spouse's CPP because they don't add them together. The max CPP is set at the maximum that one person could get at 65. So easy summary is if I've stopped working and I could use that extra cash flow, then I should turn on the tap. And I can discuss that with you more, the person that asked that question, if you wanted to reach out to me.
The one in the Q&A is just you can only deduct non-registered accounts for fees, which is correct. So TFSAs, RSPs, management fees on that are not tax deductible.
Good. Looks like no other new questions. There's still 85 quiet people
They're always quiet online.
Yeah, exactly. They're just having their tea, waiting for us. So I guess we can wrap it up then, gentlemen.
Yeah.
Yeah.
Okay.
Thank you, everyone, for taking the time
Thank you.
out of your day to, we're here almost 2 hours, so we appreciate it. Hopefully you got a lot out of it in terms of the investments from Elvis and RSPs from John and everyone's favorite real estate topic from Robert. And hopefully I just made tax time a little less stressful. That's all we want to do and make it a little more seamless.
Great. And just to remind everybody, it will be, as I did say, you could look up Luft Financial on YouTube, go to luftfinancial.com. We will post the replays there so that you can study this in more detail. But if you have specific questions for your advisor, please reach out. And if you're overdue for a review, it's a great time to reach out as well. And thanks everybody for attending. Let us know too, guys, if you've got other topics you'd like to discuss. I mean, our goal as a team is to probably do one of these bigger ones at least semi-annually and fill in the gaps with smaller webinars that each of us will probably lead, those 5 to 10 minute discussions. So if you'd like to see something that we didn't touch on today, please reach out to any of us.
Absolutely. Thank you, everybody.
Thank you. Have a great day.
Thank you.
Today, we thought, especially given the events of 2022, we'd reach out to everybody and do a webinar to go through some pertinent topics that we think are really important to focus on right now. Our regular disclaimer, as you know, we obviously present information that we deem to be reliable. And if you have any specific questions for the team, please reach out to us directly. As everybody knows, the team has grown quite substantially over the years. You've got your 4 senior advisors, Aaron, John, Ryan, and myself. Our head analyst,